partner to this IPO and IFL Capital Services, it is our true privilege to welcome you all to the press conference for the IPO launch of Gaja Alternative Asset Management Limited or Gaja Capital, as it becomes India's first publicly listed pure-play alternative asset manager. Today marks not just the unveiling of an IPO, but the result of years of dedication and discipline and ignition of a powerful journey. As Gaja Capital takes this transformative leap into the public markets, we celebrate the unrelenting pursuit of performance. Now, before we dive into the story that brings us here, allow me to introduce the leadership team we have here with us today. We have Mr. Ranjit Shah, Promoter and Executive Vice Chairman, Mr. Imran Jafar, Promoter and Executive Director, Mr. Himanshu Shah, the Operating Partner. With immense pride and honor, we bring you the remarkable growth story of Gaja Capital. Gaja Capital is a well-established, independent and homegrown alternative asset management company with over 20 years of experience. It acts as an investment manager to India-focused funds, including the CAT 1 and 2 AIFs, and also acts as advisor to offshore funds which provide capital to companies in India. The homegrown character of Gaja Capital is rooted in the backgrounds of its promoters and senior management, all of whom have developed their careers in India and are Indian citizens. As highlighted earlier, Gaja Capital focuses on the high-growth alternative asset management industry in India, which has a significant headroom to scale. As per CRISIL report, the AIF segment is expected to remain one of the fastest-growing managed products categories over the next few years as more institutional investors, UHNIs and HNIs seek out differentiated products that provide them an option to generate better returns on their investments. Gaja Capital has a successful track record of investment and deployment of funds with an average MOIC of 3.3x across the prior investments and the Gaja Capital funds. Gaja Capital follows an invest and collaborate approach with a key focus on value addition to its portfolio companies. The process incorporates an active engagement and participation beyond capital infusion and is achieved through its operating team. One of Gaja's fundamental philosophies is to have aligned interests with those of the limited partners and portfolio companies. This is achieved by investing their own capital behind their strategies, reflecting their commitment and confidence. They have long-standing and well-established industry relationships with a diverse global investor base spread across over 20 countries, including India, Europe, USA, and the Middle East. They have a proven track record of delivering strong financial performance, with their PAT growing at 35.34% CAGR over FY24 and 26. Their PAT for FY26 stood at 82 crores and PAT margins at 51.94%. Last but not the least, the company is led by experienced promoters and management team with significant experience in investment and operational management in the alternative asset management industry in India. I would like to now touch upon the deal specs for this IPO. The price band set for this IPO is Rs 152 to Rs 160 per share. Issue size is Rs 550 crores, comprising of 450 crores of primary capital and 100 crores of offer for sale. This brings the market cap to around 2,256 crores at the upper end of the price band. The anchor is scheduled on Tuesday, August 18, 2026, and the issue opens to the public on Wednesday, August 19, and closes on Friday, August 21st. The listing is expected next Wednesday, August 26, 2026. As the left lead manager, GM is proud to partner with Gaja Capital at its incredible milestone. We believe this offering presents investors with an opportunity to partner in the long-term growth story of India. We look forward to strong investor engagement and a successful listing.
Good morning, everyone. Maybe I should say Kencho, but since the presentation is in English, I'm going to say it in English, if you don't mind. But it's a pleasure to be in Ahmedabad, and I just noticed that the snacks also are Gatias here, so the best place to have a conference. What I want to do is start off by telling you how alternative AMCs compare with mutual fund AMCs. Since you're all familiar with mutual fund AMCs, just to give you a background of what alternative AMCs do. So we invest in private companies, not in public companies. Typically, we work with these companies for 5 to 7 years. It's more an operating business than a financial business. And then we exit these companies. And in doing so, we create returns for investors in our funds. What we are doing is we are taking the AMC public. So the AMC sits above the funds. There are various funds we manage, and the AMC is the manager to these funds. And it's not the AIFs that are going public, it's the AMC that is going public. So just like you have mutual fund AMC is going public, we are the alternative asset manager going public that manages AIFs. So with that in context, I will quickly take you through the presentation and certainly leave enough time for questions. So we have been around for 20 years. We have a track record that exists almost since AIFs have been around in India. So over the last 20 years, we've created a significant track record of performance. On average, we do about 3.5 times multiple on invested capital across all our funds. And it's a performance that has delivered top quartile performance and in some cases top decile performance globally to global investors. Most of our funds are subscribed to by global institutional capital. So, and recently in Fund 4, we also invited domestic institutional capital. So our investors at the AIF level are all global and domestic institutions. We also have a large amount of stability. The team has been together for 20 years in this journey. We have a highly differentiated model. We have a company structure which was there from day one. Most private equity firms are structured as partnerships where individuals take the profit and there is very little retention of value in the business. We did things differently. 20 years back, we saw what was happening in the West. Goldman Sachs converted from a partnership to a company. Blackstone did the same. And we saw what was happening and we knew that India will become large enough in alternatives for us to capture the listed AMC opportunity. So this was not a recent phenomenon. 20 years back, we did this as a company and therefore we have created value in it and now we have a net worth, as you can see, of about 600 crores through retaining all these profits in the company. We also have team ownership in this entity. So even post-issue, the team will own substantially most of the cap table, at least about 65 to 67% odd, and continue its retention. Very little is being sold in the OFS, only 100 crores, which represents less than 5% of the individual holdings of the sellers. And most of this issue is for primary capital into the company, and I'll explain to you what the use of proceeds will be. The company is profitable. You can see that we have grown our profits steadily and at a high growth rate over the years. Our compounding rate in profits is about 30%. We've grown from about 40 crores to 62 and then to 82 crores. And hopefully this trend will remain. I'm unable to make a forward-looking statement, but that trend looks very steady. And our net worth has also increased very substantially. 600 crores is, also includes 125 crores from a pre-IPO round that we did 1 year back. And some of India's best investors joined the cap table at that time. We have several firsts and several milestones over the 27-year journey, 20 years as Gaja Capital and 7 years prior as the View Group. I'm not going to get into this, but needless to say that we have several innovations over this period. We are the first to do a controlled transaction in a bank, RBL Bank. We were the first to do a controlled transaction in education and so on. Now I want to explain to you why alternatives is a very important part of the Indian economy. So roughly speaking, alternatives right now is at about 15 lakh crores of committed capital. Mutual funds right now are 80 lakh crores. But guess what? about 8 years back, mutual funds are exactly where we are now. And we are the fastest part of the growth in financial services. We are growing at a very high CAGR of, the industry is growing, the AIF business is growing at about 25 to 27%. There's a very good CRISIL report in our DRHP which will explain to you why this industry is growing so well. And therefore we do expect that our business will be as big as the mutual fund business in about 8 years' time. So we think we will be where mutual funds are today. And very few companies will be listed in this space. We are of course the first. There will be a few more. But since most of them have not been structured as companies, we're not sure how many will come out as listed AMCs. There is also, besides the strong demand for AIFs, as you can see, and AIFs are growing faster here in comparison to bank deposits, in comparison to managed investment products, in comparison to mutual funds, of course. But on the next page is something very interesting, that India is the savings factory of the world. And of course, maybe within India, it's going to be Gujarat, who are the biggest savers and biggest investors, as we all know. But there is a supply side coming into AIFs also. So banks are increasing their allocation to AIFs. Insurance companies are increasing their allocation. And the government is opening up some very large schemes for funding AIFs. So you would have read that the RDI fund of the Government of India, 1 lakh crores, SIDBI fund of funds, 1 lakh crores. NPS has announced that they are starting a fund of funds for AIFs. So we are at a very sweet spot. As an AMC managing AIFs, we have a strong demand for AIFs, we have a strong supply of money for AIFs. And we are sitting in this middle to take advantage of this unique opportunity for India. Now, unlike mutual funds, which have one stream of income, the first stream, they have a management fee, we have 3 streams of income. We have a management fee, we have what is called carried interest, that is industry jargon for profit share. So let's, just to call it profit share. So if we deliver a certain return to our investors at the AIFs, then we can participate in the upside. And the third is, for every AIF, we also make our own contribution, which we call sponsor contribution, and therefore we make the gain on that sponsor contribution also. So we have 3 sources of income as compared to the mutual fund business model, which has only one stream of income. As a result of which, mutual fund AMCs tend to have yields of about 0.5% on their AUM. We have yields of about 4.5 to 5% on our committed capital. So it's a richer stream of income. Sponsor commitment is a very important part of our business. At least it's a very important part of the Gaja strategy. Over the years, we have invested about 6.4% as our own capital into the AIFs that we manage. And the reason we do so is by doing that, we become partners with our investors. We can raise funds faster. We can raise funds at lower cost. And we can also participate directly in the upside of these funds. As we move along, one of the main uses of funds is of the primary capital that we are looking to raise in this IPO of 450 crores. All of it will go as sponsor contribution into our future funds. And that will generate the return as sponsor gains on sponsor contribution. This is the leadership team. 3 of us have been together on the first row since day 1. But there are also others who have joined. They have joined as junior associates and have risen to partners. This is a meritocratic system. We have no relatives in the firm. Himanshu Bhai here is not a relative of mine. Abhinav Jain in that is not a relative of Gopal Jain. These are common surnames, as you know. So it's a totally meritocratic system. And also the team, till now, except for the 7.7%, the 16.7 is extended team members and 75% is owned by the team. So everyone's skin is completely in this game, and even after the issue, all our wealth will really be in the company, aligned with investors. We have had a board for 5 years. This is not a board that was designed for an IPO. Mr. Sinha is the chairman of the board. As you know, he is the two-time chairman of SEBI. He is also the author of AIF guidelines. He was running UTI AMC, and he has been the driving force behind getting brokers to go public, getting AMCs to go public, stock exchanges to go public, and now alternative AMCs to go public. We have Manish Sabarwal, who's the promoter of Team Lease and who now works with the government also on decriminalization. Prithvi Haldia, you may remember, he's a veteran of Indian capital markets. Arindam is the ex-CEO of BCG in India. Shailesh Haribhakti is a strong votary of corporate governance. And Sheetal Mehra is an executive trainer and runs an NGO that we have supported from day one. So on this slide, I'm going to describe to you what we do at the fund level. This is not about the AMC, this is what we do for individual funds. Basically, we buy companies that are profitable from the VC ecosystem. These are high growth, high tech companies. We buy them from when they are unit economic positive or they are positive. We work with these companies for 5 years. We attach our operating teams to these companies, and after 5 years, we exit them to either an IPO market or to large buyout firms like KKR and Blackstone who are waiting for these companies, or strategic sale. So we have done all these. We only invest in private companies, and therefore for shareholders of our AMC, this is a great way for retail investors to get exposure to all these underlying themes. It's very difficult for Indian retail investors to invest, say, in AI. How will they do that? They can't invest in an AIF because the minimum amount that is required is 1 crore, right? They cannot invest directly because that's a high risk thing. So through a listed AMC, they will get exposure to AI, quantum cybersecurity, all these new technologies with a very low ticket size and a liquid asset. So that's the big advantage for retail investors to invest in a listed AMC. We work with companies at 3 different levels. The reason why I'm elaborating on this is because this is an integral part of our strategy. So level 3 is very large companies where we are on the board, but we are an active board and all committee members. So take an example like RBL Bank. Thanks to our board participation recently, RBL Bank had one of the largest inward investments into the banking sector, $3 billion from Emirates NBD. Level 2 is where we work with younger companies, but they have good management teams, and we do strategic M&A for them. We make sure that these companies get transformed by additional M&A. An example would be a company like Avendus, where we created the M&A for Spark. Spark Capital got added to Avendus, and therefore Avendus got ECM capabilities. It was predominantly a private company banker. And level 3 is where our teams get involved on a daily basis with companies. They embed themselves in these companies and work on broadly 3 areas: the CFO's office, revenue enhancement, and talent acquisition. So someone like Himanshu, you can talk to him after this. He has worked within these companies, running them and creating value. So we believe that the path to value creation is through a strong operational involvement with these companies to create our returns. So these are the returns that we have created in each fund. So fund, look at the table called, the column called MOIC, that's multiple on invested capital. So the fund that we had raised in 2005 was a 5.6x. 2007, which you remember was the worst period, GFC crisis in 2008, we were the top decile fund actually, 3.8x. Funds are defined by vintages, so if you start a fund and it's a very bad vintage, it might be low. If it's a great vintage, it might be high. Fund 3 is 1.9x, it's a top quartile fund. And Fund 4 is 1.7x, but it's an IRR of over 30% because it's still being deployed. It's a very young fund. So this is considered a very good performance in the funds business. On average, we do about 3.5 times multiple on invested capital. Our investors, as I told you, are global institutional investors. So like from the US, you would have the World Bank, you would have some of the state pension funds, Morgan Stanley's alternative investment platform. From India, SBI Life, HDFC Life, and so on, the government sovereign fund. And at any point of time, we have about 300 to 500 prospects in addition to these 300 active investors. Now the advantage of having global and domestic institutional capital is that it's highly repetitive. So when we raise a new fund, we don't have to embark on a new journey again. Most of the folks who have invested earlier come back and come into the next fund. So the ability to raise funds is very important, and the ability to raise funds at low cost is super important. If we had used a distributor, it costs 4 to 5%. Our funds, as you can see in the DRHP, has been raised at less than 1% cost. So that's the luxury of this business. We had covered earnings growth. We are a high growth, profitable PAT engine. We also have a strong return on equity profile. We have very high PAT margins, 50% plus. Cost to income ratios will keep decreasing because we have operating leverage in the business. We can do more with the same team, and the team cost is the bulk of our cost. So that's where these margins will increase further. So as to distill the business and to make it really simple for you, fund size gives us management fee. Our performance fee gives us profit share. Our sponsor contribution gives us gains on sponsor contribution. And our low fundraising cost reduces our expense outflow. So this is the way our business model is structured, and this is the way we make the PAT that we make, which was 82 crores for FY26. In our main business, this is the way we have raised funds. In Fund 2 was about 900 crores, Fund 3 was 1,500 crores, Fund 4 is 1,775 crores, Fund 5, which we have applied to SEBI, and SEBI will hopefully clear it soon, is a 2,500 crore fund. This relates to the strategy I described, where we invest into young companies and help them grow. We have one more strategy that we created a year back, which is the secondaries business. So there are many venture capital funds in India who cannot exit and create liquidity for their investors. So this is a specialized business run by a partner who was running Lexington's business in India. Lexington is one of the global players in secondaries. So the essential part of this business is we provide liquidity, we buy out portfolios from VC firms at a substantial discount. So the trade is, here's liquidity, give us a substantial discount. So it's a very profitable trade, and it's a specialized business, and it's going to be very significant in India. And this is the first of its kind in India to provide solutions to VC firms who are stuck for liquidity. As I mentioned, we had done a pre-IPO in June last year at 144 rupees a share. HDFC Life took the lead there. SBI Life was participating. Volredo and OneUp represent the interests of Mr. Akash Bansali and Jagdish Master, who are both veteran investors in India. And some others include people from our ecosystem. And this was done at 144 rupees. Our IPO will be done at 152 to 160 rupees. The upper band is 160. So in this case, this is one of the few cases I would say where the pre-IPO round is still lower than the IPO. So pre-IPO investors are getting an uptick in the IPO, and actually all of them are coming back for the IPO again. So we've covered this 450 crores primary, 100 crores secondary, and the IPO is scheduled for next week. The anchor book will be on 18th, and 19th to 21st is the IPO. Just to summarize, we are managers of AIFs. AIFs is a very high growth business on the demand side and on the supply side. We are uniquely placed because we have been around for 20 years with a track record in performance and substantial hygiene through governance, and a structure that enables all the economics to be accumulated in an entity where all shareholders share. We think that compared to our peers, we will be valued very attractively, and our peers are the mutual fund AMCs, which are traded at about 30 to 35 times price to earnings. We think we'll be very attractively valued, and we think that we have a long runway to go in India, because AIFs is only the beginning in the Indian story. As I told you, it's going to be as large as mutual funds in just about 6 to 8 years' time. So we'll be witnessing the rise of a very large industry, and we'll be the first. So with that, we'll take questions, and love to get your questions.
How do you think Gujarat is going to respond to your call?
So Gujarat is always very responsive to high quality ideas on the investing side. We believe we are a very high quality and a unique idea. It's not the first time we are in Gujarat. I've been around for 40 years. So I have a lot of experience with Gujarat as investors. So I have no doubt that people will see the simplicity of this business model, and the prospects for AIFs in India are unique, and will respond accordingly.
And what is the proportion of your revenue that is coming from this performance fee?
Roughly half is fees and half is performance fees. And of the half performance fees, roughly half of that is carried interest, that is the profit share, and about half is gains on sponsor contribution.
My last question is, give us 3 reasons why should one invest with you. In short, 3 reasons to invest with you.
But I have a bad answer.
The first reason is we are India's first alternatives AMC that is going public. There is no precedent to this. The second is we are a 21-year-old business. We're not just good at what we do at the AIF level, where we've generated performance. We've also matched that performance with the best-in-class governance and hygiene at the AMC level. You all can read up on the board of directors and how we work. And finally, we are not just a young startup that is trying to do this for the first time. We're a 20-year-old business with a strong balance sheet, with internal accruals, with high PAT margin, a very good return on equity, and a very good predictable stream of earnings per share and earnings per share growth.